Hey, what is going on, you guys? In this video, we're going to be going over a dividend stock that I have not seen talked about very much over the past few months, and it currently has a starting dividend yield of nearly 9.25%. And the dividend stock that I'm talking about is Omega Healthcare Investors. You can see it is currently trading at $29.08 a share. It's down 3% year to date, and over the past year, it is down 20%. Which has helped lead to the really high dividend yield. So in this video, we're going to be going over a few things. The first thing we're going to do is we're going to jump into my stock valuation spreadsheet to see if we can find the intrinsic value of this company. We're also going to be going over the dividend growth, the dividend safety, and the historical dividends of this company to see if it's a good investment for dividend growth investors or investors who are more aggressive with their dividend yields. So let's go ahead and jump into my stock valuation spreadsheet. And on this spreadsheet, you can see I've plugged in OHI and all the data has filled in automatically. So you can see just how large the dip has been over the past 365 days. It's down 20% over the past year. Past 2 years, it is up 30%. But with it down 20%, I think as a dividend investor, this could provide a good opportunity. So let's go ahead and look at our 4 valuation models. We have Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. And all of these will roll into our output tab. So let's go ahead and jump into Graham's valuation. And in order to perform Graham's valuation, we are going to use this formula that Benjamin Graham himself created. He coined it in the book, The Intelligent Investor. I'd highly suggest reading that book. It's one of the greatest investing books of all time. But with that being said, let's go ahead and use this formula to find OHI's intrinsic value. And you can see the first thing we need is our earnings per share. For OHI, it's listed right here at 1.71. We then add our growth factor. And analysts are projecting kind of a slower growth rate, and that is because OHI is a REIT, so they are required to pay out over 90% of their earnings in the form of dividends, which is great for dividend investors, but it is going to lead to slower capital appreciation. So I'm projecting a 5% growth rate right here. You can see next thing we're doing is we're multiplying this by 4.4, which is the average yield of AAA corporate bonds. Once we've multiplied all these numbers together, we're going to divide it by Y, which is the current yield of AAA corporate bonds, which at the time of this video is currently sitting at 3.41. So once we plug all of these into this formula, we can see that our intrinsic value is $26.48 a share. So that is a little bit lower than the current price. So that's not the best sign, but I think there are a couple of better ways to value a REIT instead of using Graham's valuation. And so let's jump over to our discounted cash flow. For a REIT, I really feel like a discounted cash flow is not the best way to value a REIT. I'll go into more details in that in another video, but let's go ahead and jump into our multiples valuation. And for our multiples valuation, you can see I've listed off 4 similar REITs. And what we're doing for our multiples valuation is we're using a price to earnings multiple in order to value OHI. So what we're doing is we're taking the stock price of all 4 of these companies, which you can see right here. We're looking at their earnings per share. So we're taking the stock price and dividing it by the earnings per share to find our price to earnings multiple. So you can see they're almost all in that 36 to 30 range here. So I took the average price to earnings and multiplied it by OHI's earnings per share. So if people were to value OHI essentially with the average price to earnings multiple here, their intrinsic value would be $58.91. So that is much higher than the current price of OHI. But let's go ahead and jump over to our dividend discount model. And obviously we are looking at a REIT, so in my opinion, I think the dividend discount model is by far the best way to value a company that qualifies as a REIT. So let's take a look into this valuation that I have created. And essentially the idea behind the dividend discount model is we can value a company based on how fast they grow their dividend payouts and how much they're paying out in dividends. So essentially what I have done is I've plugged in how much they have been paying out quarterly in dividends over the past few years to find their yearly dividend payout rate. We can then see based off of this exactly how much they have grown their dividends over the past few years. So we can see it was growing pretty rapidly, but it has started to slow down. But over the past few years, their average growth rate is 4.2%. After diving into the company's metrics just a little bit just a little bit more. I do think that the growth rate will be a little bit slower than this, so I'm projecting a very conservative 2% growth rate for this company. After applying a discount rate of 9%, we can see that according to our dividend discount model, we are finding an intrinsic value for OHI of $39.05 a share. So let's go ahead and jump over to our output tab. And you can see on our output tab, we have our valuations according to what we found. And so with Graham's valuation, we're looking at a intrinsic value of $26 a share, multiples $58 a share, and our dividend discount model $39.05 a share. So in order to reduce some assumption risk, I typically like to average all of these numbers, and you can see when I average them, the intrinsic value is $41.48 a share. And when you compare that to the current price of $29 a share, that is 29% lower. But now I am a value dividend investor, so we always want to apply a margin of safety. So let's say in this scenario, we want to apply a 15% margin of safety. You can see our spreadsheet is telling us that this would be an acceptable buy price of $35.26. So based on this is a stock that we should be buying. But like I mentioned earlier, I do believe that the dividend discount model is by far the best way to value a REIT. So even if we take out these other valuation, we can see that our intrinsic value is sitting at $39 a share, which would lead to an acceptable buy price of $33 a share. Now, there's probably a few things that you're thinking. You're thinking, okay, it's telling us to buy this stock, but I feel like we don't yet have enough information. And you are exactly correct. Anytime you want to invest into a dividend paying stock, there's a few different things that we should look at. And the first thing we should look at is if we jump back over to our stock screener, and let's go ahead and zoom out. You can see this company currently has a payout ratio of 151%. Okay, that is a huge red flag typically for most stocks. But what a lot of people don't understand is that the payout ratio for REITs and for typical dividend companies is actually a little bit different. There's actually a much better metric than payout ratio to look at when you're considering investing into a REIT. And that's actually exactly what this article here is pointing out. So while REITs need to pay at least 90% of taxable income, most equity REITs pay 100% or more. And so obviously this does sound very unsustainable, but that's not always the case. If we scroll down a little further, we can see that funds from operation is a much better metric to look at when you're considering a REIT. It adds depreciation back in and makes a few other adjustments to give a clearer picture of a REIT's profitability. So it gives us a little example here. If a REIT earns taxable income of $1 per share and has funds from operation of $2.50 a share, it wouldn't be unusual to pay out $2 per share in dividends. And so that's actually sustainable. So when you look at the payout ratio, for $2 paid out in dividends for a taxable income of $1 per share, you would think, oh, that's unsustainable. But with the way a REIT is taxed, with the funds from operations being $250, that actually is a sustainable dividend. And so when we look at OHI's funds from operations, you can see over the trailing 12 months, starting in December 2021, you can see their funds from operations was $2.63. Now, that's not to say that the dividend is completely without risk. We can see that their dividend payout for Omega Healthcare investors as of March 21st was $2.68. So that's actually 5 cents over what their funds from operation is. So that actually is a little bit of a red flag. It is a little bit more risky, but if we look at this dividend growth, we can see that their management is committed to raising their dividend, but the question still remains, is that sustainable? But when I jump over and look at their annual net income, so let's start in 2017, you can see it goes from 100 million to 282 million, 341 million. We obviously had a huge decline in 2020 due to obvious reasons, but in 2021 they hit their highest level of net income ever at $417 million. So here's my final thoughts on Omega Healthcare investors. Even if this is a company that doesn't increase its dividend over the next 3 years, which I actually think they will do, this is still, at this current value, an opportunity to see some price appreciation with a massive 9.25% dividend yield. So maybe if you're an aggressive dividend yield investor or you're a part of the FIRE movement, this could be an investment that would make sense for you. Even for dividend growth investors, I do think it's possible that if we continue to see good earnings numbers from this company, that this could be an investment that we do see some solid dividend growth from. So with that being said, go ahead and do your own research on OHI and let me know in the comments down below what your thoughts on this company are. If you'd like to be able to download this stock valuation spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.